You've probably done this before. You spot a clean supply or demand zone on your chart, you wait for price to tap that level, you enter, and instead of a bounce, price blasts right through and hits your stop loss. Most traders fail here because they treat supply and demand levels as standalone signals. In reality, a level on its own is an incomplete strategy that lacks the context required to actually hold price. To fix this, you need to apply the SLC system. It stands for structure, level, and confirmation, a three-part sequence that turns a single zone into a complete trade setup. Adopting this system moves you away from guessing on random bounces and toward a repeatable mathematical process. Step 1 is structure. Before looking for an entry, you must zoom out to a higher time frame, like the 1-hour or 4-hour chart. This allows you to diagnose the market's overarching momentum. In an uptrend, the price moves in a sequence of higher highs and higher lows. In a downtrend, that pattern shifts into a sequence of lower highs and lower lows. This creates a binary rule for the day. Uptrends mean you only take long setups. Downtrends mean you only look for shorts. If the market is consolidating sideways, you don't trade at all. Trying to trade against the higher time frame is like swimming against a powerful river current. It takes more effort for much lower odds of success. By aligning your execution with the macro structure, you ensure the market's momentum is working with your trade rather than against it. Once you know the direction, you move to step 2, isolating your levels. You drop down to a lower time frame, like the 1-minute or 5-minute, to find zones that match the macro trend. To find a demand zone, look for an aggressive upward price explosion. This indicates an area where strong buying pressure previously entered the market. You draw your level by placing a rectangle around the final candle that formed immediately before that explosive move started. For a supply zone in a downtrend, you do the opposite. Locate a sharp downward drop and box in the last candle before the collapse. Avoid minor price bumps. If the move wasn't aggressive and sharp, it means the institutional buying or selling strength wasn't significant enough. Focusing only on aggressive momentum ensures you are setting traps where large institutions have already shown their hand. But even a perfect level can fail. Blindly entering a trade just because the price touches your rectangle is a high-risk gamble. To enter safely, we use the stochastic indicator as a mathematical confirmation tool to verify that the reversal is actually starting. For a long setup, the price must enter your demand zone while the blue stochastic line dips below the oversold boundary. The actual trigger to enter occurs only when the indicator line crosses back up through that boundary. Short setups work the same way in reverse. Wait for price to hit a supply zone and the indicator to cross back down. If the price hits your zone, but the indicator fails to cross the boundary, the setup is invalid. This keeps you out of trades where the level is about to break. Once you have a valid trigger, the execution is mechanical. Place your stop loss slightly outside the supply or demand rectangle. Then set a take profit target at 2R, giving you a reward that is double your initial risk. This confirmation step acts as a filter, highlighting the setups with the highest probability and protecting your capital from zones that are likely to fail. By following this sequence, you've diagnosed the macro structure, mapped institutional levels, and waited for mathematical confirmation. In live markets, the urge to rush trades or succumb to FOMO is high. When the candles are moving fast, it is easy to abandon your plan. To prevent emotional errors, use the SLC execution blueprint. It's a physical checklist that forces you to verify every step before risking a single dollar. You can download the blueprint via the link in the description. Keep it visible during your next session to ensure you're following the system. Consistent profitability comes from the disciplined execution of a proven framework. It is the most reliable way to navigate a market that you cannot control.